That's decarbonization as a cost, not decarbonization as revenue. When you look at causation, is a different story. And for that, you need to have forward-looking metrics that prove that a company is solving a problem. And that's what we bring to market.
Hello. Hi, everyone. Welcome back to Greenwashing. We are your hosts in physical form. We have released 2 episodes. If you haven't listened to those episodes, please do. And thank you for everyone who's given their feedback. We're very excited about these episodes.
Yeah, thanks so much for listening. And thanks so much for all the enthusiasm and the encouragement. And we've learned a lot in the process. I feel like since this is year end, feeling a bit reflective.
2023 is on the horizon.
This year has been intense, hasn't it? There's been a lot that's happened in the climate space while we've been doing these episodes. And I feel like we've learned a lot on the side. Ukraine happened, COP27, the heat wave in the UK, the flooding in
Cost of
Pakistan,
living crisis.
Cost of living crisis. I think there's a lot to think about and to reflect on.
Definitely. And I just think, this year has been very exciting. A milestone has been us launching this podcast, first of all, and having the episodes that we've had and the speakers that we've spoken to. We've just learned so much. So we just want to continue doing this and bringing great content. So we are going to dive into episode 3 right now. Super excited about this speaker. Once again, she's also a woman.
She's brilliant.
She's also a woman. Her name is Gabriela Herculano, and she is the founder and CEO of a company called iClima Earth. They are a London-based fintech, and they're focused on creating sustainable ETFs.
So climate positive is the term that she used.
Exactly.
The companies, the ETFs, and the portfolios that she invests in are specifically focused on the climate and specifically focused on decarbonization, and not just companies with a net zero strategy.
Exactly. So I think what she mentions is the incumbent players. So, like we all know BlackRock, Vanguard. If you actually dig into their sustainable indices, they're all focused on companies which have decarbonization as a cost rather than decarbonization as a revenue item, which means that you see huge companies which are looking to decarbonize and remove carbon from their operations, but their main operations are not focused on decarbonization. Like you can have any company as part of these portfolios. And what she was trying to say is the reason she started this company is she found there weren't any indices available looking at decarbonization as a revenue item rather than cost item. And so that's what she's bringing to the market.
There's a big funding gap into green and decarbonization across sectors. Obviously, like her focus is still currently very much on energy and utilities. But that said, despite ESG funds declining in their returns this year because of all the volatility,
that's Ukraine, across all Western markets.
Across Western markets, fund flows still continue to be positive, which is great news, I think. But that said, she does talk a lot about, where capital needs to be directed, where it still needs to be channeled, what the gaps are, and especially maintaining that focus in all of these energy shocks that we've faced today, and just making sure that we have that tunnel vision in a way, right?
She's super smart. Like, we had so much content for this. It was so hard to edit.
Something that I think is very important is that she has been in the sustainability space since the 90s. I feel like the gears have been turning in her head for a very long time.
Yeah. She started her career in finance. Predominantly, she spent time on energy projects and predominantly renewable energy. So she just had so much corporate experience. She did an MBA, and then eventually after the MBA, she founded this business. And we dug into all of that, and we asked, what do you think it helped you? And she really goes into her backstory, and I think it's just so useful, especially we're all young in our corporate careers.
Yeah.
And she even said, I think at one point, the only regret I have is not starting this business earlier.
Yeah.
But obviously she's a super smart woman,
yes,
like everyone that we've interviewed. So yeah, I'm super excited
Yeah.
about this. Maybe a lot of us, as our New Year's resolutions, want to invest more in companies. We want to invest more green. We want to invest more ethically. We want to do more ethical things or green things. So I think where you put your money is going to be really important, especially because with the way the market is going, we are all a little bit skeptical about whether to even invest or put our money into like funds at all. So it's a good eye-opening episode. So without further ado,
let's get on with it.
Let's dive into it. Hi, Gaby. Thank you so much for joining us today.
I'm delighted to be here. Thank you so much for the opportunity.
Great to hear. So, to start from the beginning, and a question we like to ask all our founders, what gets you up in the morning, and what does the word purpose mean to you?
It is a great question. What gets me going? Green swans. And that is an expression that John Elkington came up with. He's the same person that coined the phrase people, planet, and profit alignment. So he's a UK based expert in sustainability. And he wrote a book where he talks about green swans, these solutions that are in our economy, proven technologies, solutions that can scale up very fast and reshape the planet in a very material way. And that what keeps me going. And I wake up in the morning with that huge sense of purpose to look for the companies that are leading the way, leading this transition to a much more sustainable economy, a very beautiful, prosperous future that I think we can look forward to. And our conviction is that the convergence of all of these solutions, they boil down to two key technologies, solar panels and batteries, and they will reshape large industries in a very material way. So green swans is definitely the answer.
That's fascinating, Gaby. Just something a little bit more about your background. Your foray into sustainability was all the way back in 1992 when you attended the UNFCCC Earth Summit in Brazil. And you've probably observed so many changes in the finance and energy sectors ever since. So, at what point in your journey did you have this idea to create a company focused on sustainable indices? And what led you into beginning iClima Earth?
That was about 3.5 years ago. So I went to the 1992 summit in Rio. I was working for my mom. She has a PhD in sociology, and she was doing a lot of work on environmental causes. And I was just a teenager, but it was a very interesting experience. I think that it's been 30 years since that event. So I went to business school. I worked at Wall Street. I worked at Lehman Brothers. My background is predominantly in energy, but renewable energy most and foremost. When I graduated from Wharton in 2002, I joined GE Capital, and we developed and invested into a lot of very large utility scale solar and wind across Europe, from Portugal all the way to Germany. That was way before parity between renewable energies and fossil fuel types of energy. But 3 years ago, I tried to put together a portfolio for a friend of mine that was running a family office, and she wanted to invest beyond renewable energy. So she asked for my help exactly because of my renewable energy background. And we really struggled. It was really hard to put together a portfolio or look for products, exchange traded funds or mutual funds that were telling the story of climate change mitigation the way that we thought was relevant. So we had a meeting of the minds with my two other co-founders. Coincidentally, all went to Wharton, and my COO and I, we worked together at G Capital for many years. And we saw not only a business opportunity, but one where we would find, again, going back to our first question on purpose, a lot of purpose, the motivation to bring to market something that shifts the narrative, something that puts the spotlight into climate change mitigation, climate change adaptation, circular economy,
solutions that allow us to represent that path to the green swans. That was very much something that we thought that the big incumbent players would not be doing. So we found a room for us to come to market, raise our hands and say, this is the way we think it should be done. These are the relevant investment opportunities, exciting investment opportunities. We're talking about the largest CapEx cycle ever, biggest value creation for our generation. And yet traditional financial institutions are not telling the story. So we wanted to do it ourselves, and we wanted to do it in a different way. So we don't believe the green swans are there because we want them to be there. We do believe that they are there because the data tells us so.
Did you imagine that you would come out of business school and pursue an idea like iClima, or did you have slightly different intentions?
Yes and no. I've always wanted to do something entrepreneurial, but my generation is a little bit of, let's prove ourselves, like get, names in our resume, more, have that experience that we can use and leverage large institutions and go through the ranks from vice president to managing director, and then finally have, at some point, the ability to then move to a different role and start a different business. So I did a little bit of that. I left G Capital before I became a managing director. So I think that the business school has helped in a very material way. The relationships that we developed, and most of our investors and backers all went to Wharton. So in the way that ecosystem of entrepreneurs and professors that are still, I just came back from my 20th year reunion. They're still there for you. So that has been, very, very helpful as I made the transition into entrepreneurship.
Yeah, that's fascinating. And I mean, it's interesting how you talked about data at that point as well, and how on the business school side, it helped you on a very, very practical front. And it's really interesting to see this journey. Um, so you've also written weekly for NASDAQ. Can you talk a little bit about how this work is also important to you and how it's serving your wider purpose and fitting in with your leadership role at iClima?
Yeah, we have this opportunity, this invitation that meant so much to me because I write weekly to the NASDAQ special effort on the world reimagined. So I love that they wanted me to share our views on that world reimagined. So I talk a lot about distributed generation, about climate change adaptation, about the solutions that can reshape our grid, being competitive and making economic sense. We're on that path. I think I've done already 17 articles, and it forces me to sit down every week. Because sometimes, being an entrepreneur, you have so many different jobs and you go from fire to fire. So I just having to set aside a few hours every day to just sit down and think about very big trends and summarizing a lot of data, summarizing. So there's three aspects to everything that we do: the technology readiness, the sustainability. Does this really move the needle? Does this make the planet better? And the financial aspects. Are these companies going to be profitable? Are they going to be growing very, very fast? So the NASDAQ exercise forces me to just sit down and think very deeply and put together all of these aspects.
That's incredible. Any kind of thought leadership is very inspiring, and just the fact that you have time to balance, being an entrepreneur and also writing your articles, and in a way they kind of work well together. So Gaby, kind of moving a little bit away from your own background and maybe starting off with an industry snapshot. 90% of ESG investment goes into the top 5 investment firms. And I think in 2022, this equated to over $2.7 trillion. What are the approaches that these investment funds are taking towards ESG investing? And what kind of impact are they having on the industry overall in terms of outlook towards sustainability? And then finally, would you also say their ESG investment styles are all broadly consistent with one another?
Those are great questions. ESG became a household acronym, and the whole idea of ESG, as we now refer to it, became more concrete when this Swiss PhD wrote an article, phenomenal title. It's called Who Cares Wins. And that's very much the basis of how the data providers started to gather information and numbers that would represent environmental, social, and governance. The problem we see in the bulk of the funds that are ESG funds is that the whole industry evolved around the idea of ESG scorecards. ESG was never supposed to equate to ESG scorecards. But the problem is not just that they are scorecards, but they are opaque. Depending on your scope, your measurements, and the weights, you end up with completely different answers. And with that, it became my ESG scorecard is better than yours. So MSCI, Sustainalytics, ISS, Arabesque, TrueCost, a lot of great professionals with a lot of knowledge and experience on sustainability and ESG. Sustainability is the goal, ESG is the tool to represent sustainability, but they are spending so much time trying to sell different scorecards. They're backward looking, they're telling the story of the past. We're not going to solve the problems of the future with that obscure tool that it's very hard for a user, portfolio managers, to look through and really understand what you're trying to represent. The other issue that we have is that the way the financial industry has evolved and has been using ESG, we're commingling correlation and causation. Most of the funds that tell the story of low carbon or Paris aligned or net zero, they're telling the story of correlation. Is usually, in a vast majority of the funds, Microsoft and Google and Amazon that are very good corporate citizens, very large corporations with the means to put the effort to decarbonize. Low-hanging fruit is Scope 2 emissions, indirect emissions from energy sources. They procure electricity from renewable projects, and with that, they are deemed to be Paris-aligned and get very good ESG scorecards. That's decarbonization as a cost, not decarbonization as revenue. When you look at causation, is a different story. And for that, you need to have forward-looking metrics that prove that a company is solving a problem. And that's what we bring to market. We call it ESG 3.0. ESG 1.0 was very much about negatively screening, for example, armament and tobacco. ESG 2.0 became this use of ESG scorecards. ESG 3.0 is about causation, is about looking for the companies that can solve problems and having tangible metrics that can prove that causation. So the good news is that ESG became top of mind, household acronym. Let's not throw away the baby in the water. Let's fix this. And I think that that's where we're going towards.
That's super interesting. And that's super interesting to think about when we're also doing our own research and reading the news. But that kind of leads me to our next question. And it's a pretty good segue because you've talked so much about energy. And I guess the overall broad theme that you focused on is energy transition. Could you talk a little bit about the key themes within each of your funds and what some of the challenge you see in incorporating some of these themes going forward as well?
Thank you. It's a great question. So we've been focusing a lot on developing our own equity indices because nobody's telling the stories that we think are relevant. So we have these 6 themes: the decarbonization, climate change mitigation, climate change adaptation, long duration energy storage, smart meters, what we call LAS, which is the circular economy solution, and our last one, which we call early, all these new companies, pre-revenue with exciting decarbonization solutions, for example, QuantumScape with solid state batteries. We started with climate change mitigation for obvious reasons because it's such a big problem, but we like to think that we're focusing on how to solve some of the most existential threats that we have to society and the biggest problems that we have. So energy, we felt very compelled to represent energy in a material way. One of the reasons is because in terms of the emission level of business as usual, which means fossil fuel, it's one of the biggest problems that we have to tackle. The other motivation is because the solutions that need to scale up for us to be able to materially reshape our grid are not, again, well represented in the traditional clean energy funds. Like, again, vehicles to grid is a good example, but ability for us to do things that we've never done before. For example, demand response. We've always had this idea that demand for electricity is quite inelastic. You need for electricity at a certain point, and that is something that you cannot change. That's not true. And again, with 5G and Internet of Things, we can digitize and better understand our consumption patterns and change those. So don't charge your electric vehicle when the load curve is at its peak. Don't do a load of laundry when that load curve is at its peak. So we all can learn. And now in this energy crisis where electricity costs so much, we have the economic motivation to do so. So we wanted to represent these solutions. We wanted to represent the companies that are bringing to market very relevant new ways of going about consuming electricity, producing electricity, so very much reshaping the grid. We don't represent in our flagship fund, the decarbonization fund, companies that are pre-revenue. The idea is that you're not decarbonizing the planet if you're not selling the products and services currently, but there's over 40 names that are developing very exciting solutions, and we wanted to represent them in one index. It's a way to play venture capital in the listed space, so definitely more volatile, but also tremendously exciting.
It's very, very cool. I have kind of a slight follow up to that. I was wondering if you had any views on companies which are utilizing nuclear as a solution, and I guess sort of an intermediate step before they fully transition to providing energy via renewable sources like wind and solar. For example, EDF. They are utilizing nuclear at the moment as a transition phase. So, did you have any views on nuclear?
We negatively screen nuclear. It's not just about emissions. It's not just about gases. It's about sustainability. It's about the world that we think it's a world of abundance, a world that is just, a very just transition. And EDF, right, France is 70% nuclear, and that is a problem right now. So our view on nuclear, we can debate nuclear for many different reasons, and there are many different points to be made, but pragmatically speaking, it's just too expensive. It is incredibly expensive. Rightly so, it takes 5 to 7 years minimum to permit a new nuclear site. So it just doesn't make economic sense to go after a solution that is way too expensive and it takes too long, and we don't need it. What we need to do is accelerate the offshore wind, onshore wind, and solar, distributed solar, bring that to another order of magnitude, and firm that intermittent energy with long duration energy storage.
Moving on, Gaby, to the next segment, we want to talk a little bit about the market. Do you think it's generally accepted in the market that there is this long-term return potential from investing more green?
So if you look at 2021 and some of the best performing stocks, right, a lot of people started to rotate from growth to value. I kind of heard this from an investor. I want the names that can have their cake and eat it too. I mean, that they will continue to make a lot of money from the legacy products, because after all, there's still demand for transportation going from point A to point B, and most and foremost, that's going to be met by internal combustion engine cars. But then they will reinvent themselves and be the winners, because after all, they do know how to, sell cars and meet the demand. So they will have their cake and eat it too. And then discounting the idea that pure players, Tesla, NIO, BYD, were the big winners of the transition and the change in transportation, and following into this idea that I think is extremely risky and it could backfire in so many different levels, that you find names that will have their cake and eat it too, like BP will continue to be a cash cow with these triple digit fossil fuel prices, but they will reinvent themselves and be the biggest hydrogen player, for example, and they will, if there's anybody that can have a massive capex of offshore because they know how to do oil and gas, they definitely will know how to do offshore wind, for example. And then therefore,
exciting portfolios to be built. I think that view that ESG equates to higher returns is not universal yet. And I think that the biggest market that is not yet fully subscribing to that view is the US. It's a very polarized country and a very divided one, sadly. I think it's in Europe with the investors that we're constantly talking to, that idea that there are abnormal returns to be made if you have a representation of companies that have solid E or S or G. I think that now that is very much a universal in Europe within European investors. And I think what we're starting to see is more differentiation, where investors make that big distinction between ESG being represented through scorecards where you're commingling many concepts. So investors are starting to look for companies that are very much advancing and solving some of our largest problems. And then with that, the data that substantiates that claim that you're really advancing a solution, green cement, they're very exciting companies in line with that. And then comes the expectation of a different performance, a different return level, because you are disrupting very large industries. So seeing risks, the idea that the best defense is offense, investing in companies that are growth companies, but green growth. And I think markets will at some point very soon start to make that distinction and decouple the idea of growth and reward green growth more than generic hyper growth names for a variety of different reasons. So it's really a complex topic, and you have to have a lot of tools to be able to price opportunities accordingly.
That's so interesting. I kind of want to move on and hone in again on your work in the energy sector, because I think this is a topic that's on everyone's minds right now. So the current market has been tremendously volatile. It's been marked by burgeoning geopolitical tensions, rising energy prices. It's only worsening with global warming. And now more recently, we have recessionary scares because inflation is continuing to persist. So amid all of this chaos, I think it's safe to say that energy transition isn't really at the forefront of everyone's minds right now. Um, in your NASDAQ article, you described the situation as being stuck between a shock and a hard place. Could you talk about what challenges this current environment has posed to your indices specifically, as well as to individual companies within it? And how are you managing investor expectations?
Yeah, that's a great question. So what we think investors are pricing right now is a slow transition. There are some investors that make the case of no transition, right? So you have this very wide range of Putin solves climate change to this is the end of climate change mitigation. We just cannot afford to do that. We actually need fossil fuel. Look at the problems that we face because supply has not increased because of ESG. I've heard this from many very educated investors, and they're discounting. So let's look at one of the key solutions, offshore wind. In 2021, about 21 gigawatts of new offshore were added to different grids. This is global numbers. 80% of that was in China. So that was 17 gigawatts, just China. That brought the offshore wind capacity global level to 56 gigawatts. For us to be able to be on that path of cutting emissions by half by 2030 to 2035, some figures from IEA indicate that we will need to have just about 500 gigawatts of offshore wind in different countries. So that's a 10x pretty much from our current levels. Well, 10x is a lot, and we're talking about next 10 years, 10 to 15 years or so. So markets are saying, okay, that's not going to happen. We have challenges in the supply chain. We may not be in that deflationary cost. This is a somewhat of all the renewable energy sources, a somewhat complex one. You have to build in very tough environments, of course, offshore. The supply chain needs to unfold. Like I mentioned, for example, in the US right now, there are 11 states that are pushing about 35 gigawatts of different offshore projects through the cycle. Long Island and New York, for example, are already building offshore wind. It takes time.
it takes time. We're trying to accelerate, but investors kind of connect the dots and discount our ability to scale up all of those solutions. We're talking about solar in the US, about 1,000 gigawatts being added to their grid. Again, same time frame. How is that going to take place? Then some analysts discount that. We're not going to be able to accelerate this for a variety of different reasons: supply chain and permitting cycles and availability of minerals and all of that. So one of us would be right. There could be, if we are right and we do look for the data that substantiates how we can indeed scale up, and we look at the European Union, Ursula von der Leyen so vocal, explaining to the world how Europe can do it and putting in places the tools, which means the regulation that would allow, give an incentive for investors to invest massively and accelerate that transition. That's how we're going to replace and decommission nuclear and, of course, coal, which is top priority, and then at some point natural gas as well. So we see, and there are a lot of great minds doing a lot of research right now to model how exactly that is going to unfold. So some of us really believe, again, Tony Seba really thinks that the US could very much replace all their fossil fuel in the next 10 years just with solar and winds and batteries, of course, and in doing so get to this grid of abundance of clean and inexpensive energy that really reshapes and changes everything. So somebody will be right and somebody will be very, very wrong. Of course, we have conviction that transition can accelerate and that it will accelerate, and then willing to invest accordingly. But the companies in our universe are suffering. We are down about 22% year to date, because that acceleration is being discounted. Markets are definitely not pricing fast transition. They are pricing a slow transition or maybe a no transition.
I wanted to talk a little bit about your work. You've written extensively about blockchain, and I guess blockchain and its applications, particularly with regards to cryptocurrency, it's not necessarily seen as something which is very energy efficient. Crypto mining uses up a lot of energy. So it's not necessarily spoken about in the best way in regards to the climate impact. However, the way you've discussed it in your article is it will actually help us on our path towards decarbonisation. And this is more in regards as a way of verification, for example, in respect of carbon trading. Could you potentially talk a bit more about the role of blockchain and its various solutions in regards to carbon trading, and maybe also what your favourite innovations are in this space?
That is a great question. That is one potential solution that we were very skeptical. We looked at it. Let's just look at the data and try to understand this. So if we step back to give context, Paul Hawken, in his book Regeneration, he quantified the roadmap as the way he sees to net zero. So nature-based solution, right? As we talked about before, best way to reduce carbon in the atmosphere is by not emitting in the first place. But there's a lot of CO2 already accumulating in the atmosphere. The only proven technology, if you will, that can do sequestration in an efficient way, a proven way, are trees. So again, that nature-based solution in Paul Hawken's mind, and we looked at his numbers, we think it's about 43%. 47% is the path of not emitting in the first place. Again, innovation. 43% is nature-based, and 10% is the less harm. So less flaring, less emissions, for example, in cement, so on and so forth. So the vast majority of the way to get to net zero is by not emitting in the first place, but then not too far is nature-based solutions. So something that we have to look at more closely and think, okay, what is the economic incentive for us to regenerate? So reforestation and afforestation, what are the ways of doing this? And as of now, the best tool that we have in our hands are the carbon offsets. But there are a lot of issues with carbon offsets, from the lack of transparency to the convoluted ways to go about trading them. And that's where we looked at blockchain. Is this a solution looking for a problem, or is this a real cool technology that could be really the holy grail to make nature-based solutions, to bring that to another level, to a global level, with an exchange, for example, where we can get this voluntary carbon certificate and this voluntary market to another level. So that was our motivation to look into this in more detail. And we came across some interesting companies. Moss, which is a company that does have a token that represents carbon credits for reforestation projects in Brazil. For a variety of reasons, those projects are very important because we are preserving the Amazon forest, where trees can grow very, very fast because of where they are vis-a-vis the equator line. A company called Tucan that is trying to standardize and bring transparency to the different carbon offsets. Another company called Power Ledger, which is a company in Australia. Different solution is decarbonisation, not as nature-based carbon offsets, but one that we were very intrigued given our interest in distributed energy. It is a use of blockchain for the peer-to-peer trading of that energy surplus that one house may have and that the next door neighbor may want to buy. So we looked at blockchain from that perspective. Is most and foremost, is this, to answer the question, is this the way for us to accelerate and bring more capital towards nature-based solutions? So that's more work to be done. And I think that we are at the very beginning of converging blockchain and nature-based solutions. But what we got conviction out of this effort and exercise is that this is very relevant and could really be a game changer.
Yeah. Yeah, that's good to hear. And also the fact that you acknowledge that carbon trading, for example, is an important solution. It's not kind of the final solution, but we do need to make sure that we are making the systems as efficient as possible whilst there aren't other kind of solutions in place. So that's good to hear. So, Gaby, as you know, a major focus of our podcast is drawing attention to women-led companies. You've written about the role that women have played in sustainability. Could you perhaps draw light on any challenges you have experienced, be it funding or otherwise, as a woman founder? And what advice do you have for aspiring female founders looking to make an impact, either kind of as an entrepreneur or also in the fintech or financial sector?
A Wharton professor of mine, Professor Mauro Guillen, he wrote this book, 2030, How Today's Biggest Trends Will Collide and Reshape the Future of Everything. And he has some predictions, and all of them come from this kind of demographics point of view. And one of them is that he forecasts that by 2030, half of the wealth on the planet will be in the hands of women. And then we extrapolated that finding and prediction and taking that into the ESG context. Yes, I think it is very fair to say that women invest in a different way, and we have sustainability as a top priority. So you put all these things that we just talked about, about technology, just deflationary forces coming from the key technologies like batteries and solar panels, and the world is reshaping in a very material way. And women are leading, I think it's fair to say, in the sustainability space. London is a very unique city in that sense. There is an ecosystem that allows fintech companies and startups to grow so fast for a variety of different reasons. The talent pool is incredible. There's tax benefits for early investors. So we've been very fortunate that we've been able to meet and get to know a lot of companies. I'll give you a name, a company called Tumelo, female-led business, Georgia. She has this theory of change that she needs to empower the real asset owners to vote. So it's all about engagement. She's very big on ESG. There's a number of examples. And I think that one thing that helps women is that strong conviction and determination to make a difference and to do something different. And my advice to any female entrepreneur that has an idea is just do it. Channel that conviction and that passion. Have confidence in your idea. And I think that we are at a unique point in, I started my career 25 years ago at Lehman Brothers. I was often the only lady in the room. That never stopped me back then. And I think that now let's leverage that, the fact that it's no longer acceptable to have so few female leaders, and break the glass ceiling and go with conviction and channel the passion and the commitment, because I think that we are being heard. And I think that we're bringing new perspectives to market that potentially you wouldn't hear from male voices. So, have the courage to do it and go for it. It's not easy. It's a lifestyle. You don't start a company for a lifestyle improvement. It's 24/7. But again, I wouldn't have it otherwise, because I really have the conviction that we are about to change the planet. Capital markets will be a source of good, and we have our role to play, raising our hands and saying, look at these investment themes, how interesting they are, stories that are not being told loud enough, hear us out. And that, instead of demotivating me, it gives me a lot of energy.
That's so beautiful, Gabby, and that's so inspiring. I think for all of our listeners, especially the younger listeners, I think that we hope to impact. I want to move on to a slightly different topic. If you could talk about what type of traction or scale that you've achieved so far, what scale do you think is needed? And do you think investor capital within this industry and within the financial space is being currently allocated?
Well, we are almost 3 years old, and we are global. We have presence in Australia, across the EU. We're in the US. We're having conversations in Brazil, where I was born and grew up. We have a client in Taiwan, and we have a bit over $250 million assets under management and under license. Our goal for the rest of the year is to pitch, and we won't be shy, and we're going to go to larger institutional investors with the 6 themes and with the data as a service. And we really hope that in 2023 we will cross that $1 billion level. What we cannot manage or influence is, how quickly markets will come down, and fears of global recession and inflation and this stagflation are very real, cannot be discounted. We hope to really accelerate in our own curve, which, in other words, is to say that we now have the ambition to bring the indices and the data, kind of like a data as a service, to empower the asset owners and the investment managers, and to bring our investment themes and ideas and explain and pitch that methodology and the data that substantiates this fast changing world, right? So looking forward, what is ahead? So, for example, cars, as we know, will cease to exist in a very short time frame, and they will become computerized power plant on wheels. And we're going to use those powerful batteries inside the cars. They will be bidirectional for the benefit of the grid, and they're going to be autonomously driven. So we're going to share. We're going to bring that sustainability to another level. The batteries will have a second life after the useful life in the car. They will be used for other purposes, and they'll be recycled. It's a completely different way of living. For example, 20% of all the real estate in the US is tied to parking lots, because there are so many cars. It's such a big element of the way US society works. Everybody drives around. 20% of that real estate will then be able to be repurposed for other things. We also see a trend of us decentralizing very large industries. All that real estate in the US that will no longer have to be used to park cars that will sit idle and are internal combustion engines. They can be used for vertical farming. So we can reshape our planet in a very material way if we connect the dots and we see the convergence of these different solutions. And I think investors are going to be doing that. That is our theory of change, is that we want to empower large institutional investors to focus on these themes and these stories. And then with that, this is capitalism at its best. This is capital markets being a source of good, where funds flow through companies and more IPOs happen. So we're very excited about what is ahead. We are very excited about the world that we can build and move towards in the next 5 to 10 years, a materially different world, deeply discounted right now. We really hope to be right, and that these green swans are all there, but just not seen by the mainstream investors just yet. I'm not doing this because I'm a tree hugger. I look at the data and I objectively think that the companies that are the winners, the companies that will be above 1 trillion market cap, are the companies that are solving our biggest problems.
Final question. Could you comment on your hopes and vision for iClima over the next, say, 5 to 10 years, and the role that disruptive climate funds will play in our transition to a greener future? Is enough being done?
No, enough is not being done. We need to bring the tools and to another level. We look at potential avoided emissions. That's the technical term of how we can estimate the delta, which is high emissions from business as usual and the solutions that replace it, right? That's the metric that we look for. And then we need to bring and borrow from finance additional concepts: time value of money, time value of carbon. The money that comes to your pocket in the future is worth less than the money that comes to your pocket now. Same with carbon. The carbon that we don't emit in the future is less impactful than the CO2 equivalent that we don't emit now. That's the logic of carbon accounting. Then let's borrow something else from finance: return on invested capital, carbon returns. So let's look at those megatons of CO2 equivalent per dollar. And let's look at the solutions that are very impactful and do not cost that much for us to scale up. That's, again, telepresence. Zoom, we got used to this solution for a very sad reason, but we can scale that up very, very fast. Again, it's a software, so it's a somewhat marginal cost, extremely impactful because we all got used to that, and we can permanently replace our constant zigzagging New York to London with more Zoom, more telepresence. So again, very impactful. So we need to bring all our tools to the table, and we need to be much more systematic, and we need to speak that same language. Again, ESG as ESG 3.0, so that capital flows faster towards the relevant solutions. We have to help the invisible hand, and we can do that if we speak the same language, if we use forward-looking data, if we use the right set of numbers. We're on the right track, but we have to do more and better.
Yeah, that's great. Gaby, thank you so much for your time. I think C and I can both agree this has been such an engaging interview.
Thank you so much, Gaby. This was wonderful.